welcome to the Deep Dive. Today, we're zeroing in on Toll Brothers, America's big name in luxury home building.
That's right.
Their second quarter fiscal year 2025 results just dropped, and we've pulled together the financial news and their official report to really get a clear picture.
Yeah, and our goal in this deep dive is really to figure out what's truly driving Toll Brothers right now. We'll be looking at the crucial numbers, what the analysts are saying, and trying to understand the bigger picture for this key player in the housing market.
Definitely seems like there are some mixed signals in the data.
There are, yeah. A few seemingly conflicting signals, so we're here to unpack those and see what the underlying story might be. We're drawing on insights from Smart Karma, Guru Focus, the Manila Times, Quiver Quantitative, and naturally, Toll Brothers' own earnings release.
Okay, let's get right to it then, those headline figures. It looks like there's an interesting contrast maybe between revenue and earnings.
Exactly. So revenue actually beat expectations. Smart Karma had it at $2.74 billion. Yeah. Others, like the Manila Times, Quiver, Toll Brothers themselves, said $2.71 billion.
Right, but either way, higher than the, $2.49 billion estimate?
Yeah, significantly higher, so that's a plus. But there's a slight difference in the year-over-year comparison.
Ah, okay. What's that?
Well, Manila Times, Quiver, Toll Brothers reported a 2% increase year-over-year.
Right.
But Smart Karma noted a 3.5% decrease. It probably just depends on which revenue figure they use, the 2.74 cents or the $2.71 billion.
Gotcha. Okay, so revenue's looking pretty decent, beat estimates. But what about the earnings per share, the EPS?
Right, that's where it gets interesting. While revenue was up, EPS dipped to $3.50.
Okay, down from
$4.55 in the same quarter last year. And this is really crucial. In that same quarter last year, Q2 2024, Toll Brothers had a pretty big one-time gain.
From what?
Selling some land. It was about $124.1 million, or 1.17 per share.
Ah, okay. So if you take that out.
Exactly. If you adjust for that land sale, the adjusted EPS for last year's Q2 would have been $3.38.
So compared to that adjusted number, this year's $3.50, it's actually up slightly.
Well, it makes the current $3.50 look like less of a drop compared to the unadjusted $4.55. It's still technically a decline from the unadjusted number, but the context matters.
Right. That definitely puts a needed spin on things. Okay, moving on to sales and contracts. Another intriguing situation here.
It seems so. The total number of homes they actually sold and delivered this quarter went up.
Okay, good news.
Yeah, it reached 2,899 units. That's about a 9.8% or, 10% jump year over year, depending on the source. And again, better than analysts predicted.
That sounds pretty solid then.
It does for deliveries. However, if we look at what's coming next, the pipeline.
The new deals.
Yeah, the net signed contracts. That saw a decrease. They recorded 2,650 units in new contracts.
That's down.
Down 13% compared to last year, and below what Smart Karma estimated.
Okay, and the value of those contracts?
Also down. Fell by 11% to $2.60 billion. That's per Manila Times, Quiver, and Toll Brothers.
So hang on. They delivered more homes this past quarter than last year.
All right.
But they signed up fewer new customers for future homes.
Exactly, which leads us straight to the backlog.
Right. What's happening there? Is that shrinking?
It is, yeah. Backlog, which is basically the homes they have contracts for but haven't delivered yet, that shrunk to 6,063 units. That's a 15% decrease from the year before.
15%. Wow. And the value?
Value of the backlog also dropped down to $6.84 billion, which is about a 7%, maybe 7.3% decrease year over year. And again, this fell short of what analysts were hoping for.
So current sales deliveries look good, but the future pipeline, the backlog, is looking a bit lighter.
Precisely. That's definitely something to, keep an eye on for their future revenue streams.
Absolutely. Okay, let's switch gears a bit. Let's talk about community growth and those all-important profit margins. Looks like some better news on the community side.
Yes, there is. What's interesting here is the growth in the number of their active selling communities, the actual neighborhoods where they're building and selling.
Right.
That increased by 9.1% year over year, reaching 421 communities.
And that beat estimates too.
It did, yeah. Surpassed analyst projections. And just looking at the quarter-end figure, 421 selling communities, that's up from the previous quarter and definitely up from the 386 they had a year ago.
So expanding their footprint, that seems positive.
Definitely a positive sign for potential future sales, having more locations open.
Okay, and how profitable are those sales? Margins are always key.
Right. So their adjusted home sales gross margin came in at 27.5%.
How does that compare?
It's a little lower than the 28.2% they managed the year before, but importantly, it was better than what analysts had estimated.
Okay, so better than expected, even if slightly down year over year. What about the standard reported margin?
The reported home sales gross margin using standard accounting was 26.0%, and that was actually up from 25.8% in the prior year.
Interesting. So adjusted down slightly, reported up slightly.
Kind of shows the nuance, yeah. And then there's SG&A expenses in, sales, general, administrative costs.
The cost of running the business, basically.
Exactly. As a percentage of their home sales revenue, that ticked up slightly to 9.5%. But even that was better, meaning lower than analysts were expecting.
Okay, so even with maybe some softer demand signals, they're managing profitability pretty well.
Seems that way, yeah. Doing a decent job there.
All right, now let's get into what the folks who really dig into these numbers are thinking. The analysts, the guru investors. What's the sentiment?
Well, if you zoom out, the overall market sentiment from analysts seems mostly positive for Toll Brothers.
Okay.
According to Smart Karma, you've got 12 buy ratings, 7 holds, and only 1 sell.
Pretty weighted towards the positive then.
Yeah. And Guru Focus confirms that trend. They show an average consensus recommendation of 2.2 from, I think, 19 different firms. That basically translates to an outperform rating.
Price targets.
The average analyst price target suggests potential upside of around 32.68%. So generally, Wall Street seems pretty optimistic.
But there's usually another angle, isn't there? What about that guru-focused GF value thing? Does that paint the same rosy picture?
Good point. No, it doesn't actually. This highlights how different valuation methods can give different results.
Right.
Despite the positive analyst views, Guru Focus's own GF value analysis offers a more cautious take. Think of it as their estimate of fair value based on historical performance and future projections.
Sounded like intrinsic value.
Sort of, yeah. And based on their model, they suggest the stock might actually have a potential downside of around 12.8% from where it's currently trading.
Oh, okay. That's quite a contrast to the analyst targets.
It really is. It just underscores that valuation isn't an exact science, Different models, different assumptions.
Fair enough. What about any specific analyst takes? Did Smart Karma have more detail?
Yeah, Baptista Research on Smart Karma had a positive view. They gave Toll a buy rating.
What were they focusing on?
They really highlighted the company's growth in communities, which we just talked about, and also their strategy of diversifying their product offerings. They see those as key drivers. They also mentioned the strong Q4 performance back in fiscal 2024 as a positive indicator.
Okay. And those Smart Karma smart scores, what do they show?
The SMART scores generally suggest a positive long-term outlook. Toll Brothers scored well on value and growth,
Meaning
it looks like a decent value for its price and has good expansion prospects. They did score lower on dividends and momentum, but their resilience score was strong, suggesting they can handle economic bumps. So overall, the scores lean positive.
So we've got this mix then. Optimistic analysts, mostly, but a more conservative valuation from Guru Focus. Interesting. Let's pivot to what Toll Brothers itself is saying, their strategy, their outlook.
Right. The statement from the CEO, Douglas Yearley Jr., was pretty telling. He said they were pleased with the Q2 results.
Especially beating earnings estimates, I guess.
Exactly, exceeding earnings expectations, even though he acknowledged a, quote, somewhat softer demand environment.
Okay.
And he specifically pointed to their diverse luxury offerings and, importantly, their strategic decision to prioritize price and margin over pace.
Margin over pace, meaning they'd rather sell fewer homes at higher profit than chase volume.
That seems to be the message, yeah. Focusing on profitability in that high-end niche.
Makes sense for luxury.
Yeah.
So what are they predicting for the rest of the year? Do they update guidance?
They reaffirmed their full-year financial outlook. They didn't lower it.
Okay, that's a sign of confidence.
It suggests that, yeah. They pointed to their strong existing backlog. Even though it's smaller, it's still substantial, and their positive long-term view for luxury new homes.
What's driving that long-term view?
They believe ongoing housing shortages generally and favorable demographics will continue to support demand in their specific market segment.
And specifics. Any numbers for Q3 or the full year?
Yep, they give guidance. For Q3, they expect deliveries between 2,800 and 3,000 homes. For the full fiscal year, 11,200 to 11,600 homes. They also guided on average delivered price, adjusted gross margin, around 27.25% for Q3 and SG&A percentages for both periods.
Okay, so they're laying out expectations pretty clearly. Seems like they expect continued solid performance.
That's the forecast, yes.
Now, let's quickly touch on their financial health, balance sheet, shareholder returns. How are they looking there?
Pretty solid, actually. They ended Q2 with a healthy chunk of cash, $686.5 million in cash and equivalents.
It's good cushion.
Definitely. And they've been proactive with their debt. They extended their main credit lines way out to February 2030.
Locking in financing long term.
Exactly. And they even increased the amount available under their revolving credit line. So good financial flexibility.
And shareholder returns, dividends, buybacks.
Both happening. They announced a 9% increase in their quarterly cash dividend, up to $11.25 per share.
Nice bump.
And they've been buying back stock, too. Repurchased about 1.6 million shares in the quarter for roughly $177 million.
Okay. What about overall equity and debt levels?
Total stockholders' equity stands at $7.95 billion. That works out to a book value per share of $80.84.
And debt?
Their debt-to-capital ratio is quite manageable at 26.1%, and the net debt to capital, which accounts for their cash, is even lower at 19.8%.
And that's considered healthy for a home builder.
Generally, yeah. Often, anything below 40% for debt to capital is seen as pretty solid in this industry. So Toll Brothers looks financially sound.
Good to know. Strong foundation and rewarding investors. What about any insider moves or big fund activity? Did Quiver Quantitative pick up anything?
Quiver did note some recent selling of shares by company insiders.
Oh, okay. Is that a red flag?
Not necessarily on its own. Insiders sell for many reasons, but it's something investors tend to watch.
Sure. What about the big institutional investors? Hedge funds, mutual funds?
Quiver reported that in the latest quarter, 297 firms increased their holdings in Toll Brothers,
Okay.
while 465 firms reduced their positions.
So more firms decreasing than increasing.
In that period, yes. They also highlighted some big moves. Lone Pine Capital significantly upped their stake, while giants like BlackRock and Invesco trimmed theirs.
Interesting. Lots of different opinions reflected in those moves.
Definitely reflects varying strategies and outlooks among the big money managers.
Okay, lastly, before we wrap up, let's just briefly touch on geographic performance. Are things pretty even across the country for them, or are there regional differences?
Oh, there are definitely regional differences. The supplemental data breaks it down nicely across their 5 main divisions: North, Mid-Atlantic, South, Mountain, and Pacific.
Any standouts in Q2?
For the 3 months ending April 30th, the South region actually brought in the most revenue and sold the most units.
Interesting. Why the South, you think?
Could be migration trends, maybe different product types hitting a sweet spot there. After the South, the Mountain region was next in revenue and units.
And highest prices.
That was the Pacific region, by a pretty wide margin, actually. Highest average selling price there.
How did that compare to last year? Any big shifts?
Comparing Q2 this year to last year, the Mid-Atlantic and Pacific regions actually saw revenue decrease. The other regions grew.
Okay. And units sold?
Unit sales were up year over year in the North, South, and Mountain regions,
Okay.
but down in the Mid-Atlantic and Pacific.
So a really varied picture depending on where you look.
Exactly. It clearly shows that luxury housing isn't monolithic. Market conditions vary quite a bit across the country.
Absolutely. Okay, so let's try and pull this all together. Wrapping up our deep dive on Toll Brothers Q2 fiscal 2025. It really seems like a complex picture, doesn't it?
It really does. You've got the strong revenue beat and more home deliveries than expected, which is positive.
Right. But then on the other side, net income was down, though the adjustment helps explain some of that.
True. And crucially, new signed contracts were down, and the backlog shrank compared to last year.
Yeah, those forward-looking indicators are softer. And then you have the analyst view, mostly positive ratings and price targets.
Contrasted with Guru Focus's valuation suggesting potential downside risk.
And the company itself. Staying positive, reaffirming guidance, but emphasizing that margin over pay strategy.
Exactly. They're confident, pointing to the long-term fundamentals of the luxury market, like housing shortages and demographics.
So it really leaves us with a key question, I think.
Yeah, what's the takeaway for you, the listener?
Well, considering all these factors, the solid current results, but the dip in new contracts, is this just a, temporary fluctuation in a still strong high-end market?
Or could it be an early sign that maybe things are starting to cool off a bit in luxury housing demand? And what does that focus on margin over pace really signal about Toll Brothers' own confidence in future demand strength?
Definitely something to ponder. Is it a sign of strength being able to hold price or a defensive move against potentially weaker demand ahead?
It's worth thinking about those longer-term trends versus these short-term quarterly results.
Absolutely, a lot to chew on there. We'd encourage you to dig deeper into the sources we mentioned, keep following the news, and form your own informed perspectives. Thanks for joining us for this deep dive.